The market doesn't punish ignorance first. It punishes intelligence that believes it is in control. Most people grow up believing something that feels undeniably true. Smart people should be great investors. The logic appears airtight. If you are intelligent, you should be able to analyze information better, learn faster than others, detect patterns others miss, make superior decisions, and therefore almost automatically achieve superior returns. This belief feels fair, it feels rational, it feels comforting. But markets are not built on fairness, and they are not classrooms. Markets do not reward effort. They do not grade reasoning. They do not care how elegant your logic is or how sophisticated your model looks. And here's the reality most people never confront, because it is deeply uncomfortable. Highly intelligent people often make worse investment decisions than average ones. Not occasionally, not by accident, not because of bad luck, but systematically. They do not fail because they lack information. They do not fail because they misunderstand markets. They fail because of how intelligence behaves under uncertainty. And that is the part almost no one wants to admit. Because admitting it forces you to accept something unsettling. Your greatest strength outside the market may become your greatest weakness inside it. Let's examine this calmly, without ego, without emotion, and without motivational noise. The failure chain: intelligence, illusion of control, cognitive overreach, capital damage. This chain explains nearly every intelligent failure I've witnessed over decades in markets. Let's walk through it, slowly. Step 1. Intelligence demands coherence. Highly intelligent people are deeply uncomfortable with randomness. They are trained academically, socially, and professionally to detect patterns, build explanations, create models, impose structure on chaos. In school, this is rewarded. In engineering, it works. In medicine, law, science, and technology, it works. Because those domains reward coherence. Markets don't. Markets do not need to make sense to you. They do not owe you an explanation. They do not respond to elegant reasoning. Markets operate on probability, not logic. They move based on positioning, incentives, reflexivity, liquidity, and human behavior under stress, not on whether your thesis is intellectually sound. This is where the first fracture appears. Smart people internalize a powerful equation early in life. More thinking equals better outcomes. So when uncertainty appears, they respond predictably. Analyze more, read more, refine models, stack indicators, build narratives. This creates a subtle but dangerous illusion. If I understand this deeply enough, I can control the outcome. But markets do not reward understanding. They reward positioning under uncertainty. The illusion of control feels empowering. Quietly, it pushes intelligent investors toward overreach. They begin to believe risk can be engineered away, volatility can be anticipated, timing can be perfected. None of this is true. Markets are probabilistic systems with fat tails. Control is an illusion, and intelligence makes that illusion feel earned. Step 3. Sophisticated overconfidence. There is an important distinction most people miss. Ignorant overconfidence is loud. Intelligent overconfidence is subtle. Smart investors rarely say, "I know for sure." Instead, they say, "Statistically, this is very likely. Based on my model, given the macro setup, it sounds rational, it feels disciplined, it is often fatal." Because complex reasoning does not reduce uncertainty, it increases emotional attachment to the position. Once a narrative is built, it gets defended, contrary data gets rationalized, coherence gets mistaken for truth. At that moment, intelligence stops being a tool. It becomes an identity to protect. Step 4. The need to be right. Average investors fear losing money. Smart investors fear something deeper, being wrong, especially to themselves. Their identity is built on competence, foresight, intellectual superiority. So when a trade moves against them, they don't exit, they explain, they justify, they wait for the market to realize they're right. This isn't analysis, it's ego preservation. Markets are ruthless to ego. Step 5. Delayed loss, amplified damage. Because intelligent investors trust their reasoning, They hold losers longer, they add to losing positions, they loosen stops, they widen risk temporarily. Each decision sounds logical in isolation. Together they create catastrophic asymmetry, limited upside, unlimited downside. By the time reality is accepted, the damage is already structural, not emotional, not temporary, structural. How this fails in real life, the macro genius brilliant economist understands cycles, rates, liquidity, predicts a crash correctly, but enters too early, doubles down, then triples. The thesis is still valid. The market doesn't care, he's right and bankrupt. The data scientist builds sophisticated models, backtests endlessly, optimizes everything. The system works until it doesn't, because it assumes stable regimes, normal distributions, historical behavior repeating. Reality breaks assumptions, losses cascade. The smarter the system, the harder it is to shut down. The strategic thinker sees second-order effects, positions ahead of the crowd, but becomes addicted to anticipation, always early, rarely aligned. Markets reward alignment, not cleverness. The core misunderstanding. Here is the trap that captures intelligent investors. They believe thinking is the edge. It isn't. Thinking is abundant. Execution under uncertainty is rare. Markets don't reward those who think the most. They reward those who limit damage, survive randomness, accept being wrong quickly, separate identity from outcomes. This isn't intuitive. It's learned, usually through pain. The anti-intelligence edge. If intelligence were enough, Nobel-level thinkers wouldn't blow up funds, Ivy League analysts wouldn't underperform indexes, brilliant strategists wouldn't lose to simple rule-based traders. Markets reward a skill intelligence often interferes with: non-attachment under uncertainty, not prediction, not insight, not brilliance. Why intelligence blinds emotion? Here's a hard truth. The smarter you are, the better you are at justifying emotion with logic. Fear doesn't vanish, hope doesn't vanish, ego doesn't vanish. They put on a suit. Instead of "I'm scared," the intelligent investor says, "Volatility is irrational. The market is mispricing this. Short-term noise doesn't matter." Sometimes these are true, often they are defensive. Intelligence becomes a shield. Shields block feedback. The feedback problem. Markets speak one language, price behavior over time. Smart investors often override it with interpretation. They see price moving against them and respond with explanations, theories, context, instead of adjustment, reduction, exit. They aren't trading markets, they're debating reality. Reality doesn't debate back. Professionals eventually converge on 4 principles, usually after pain: rules over reasoning, pre-commitment over discretion, loss minimization over being right, and identity separation over self-expression. Each one contradicts how smart people naturally operate. That's why they work. Rules over reasoning. Rules exist not because markets are simple. They exist because humans are flawed. Rules contain intelligence. They don't insult it. Pre-commitment over discretion. Once capital is exposed, thinking is contaminated. Pre-commitment protects you from your future self. Loss minimization over correctness. Markets don't reward brilliance, they reward survival. Being wrong isn't failure, staying wrong is. Identity separation. Professionals don't ask, "What does this say about me?" They ask, "What does this do to my risk?" Their identity is not being right, it's executing a process. Simple systems scale under stress. Intelligence often collapses. Simple systems reduce decision fatigue, minimize emotional variance, enforce consistency. They don't require brilliance. They require obedience. Markets reward consistency far more than cleverness. Once you see this, you can't unsee it. The market is not a problem to solve. It's an environment to survive. Smart people want answers. Markets offer probability. Smart people want certainty. Markets offer uncertainty. Everything changes when you stop asking, "What's going to happen?" and start asking, "What happens if I'm wrong?" Most people believe becoming a better investor means becoming smarter. It doesn't. It means becoming less impressed with your own intelligence. The market doesn't reward who you are, It rewards how you behave, and behavior, not intelligence, decides survival.